Hello everyone, welcome back to the channel. Imagine you want to invest in real estate, but you don't have the money to buy a whole building or a bunch of properties. What if you could invest in real estate like you would in stocks, without having to deal with tenants or property maintenance? That's where REITs come in. What are REITs? REITs, or real estate investment trusts, are investment vehicles that pool funds from many investors to purchase, manage, and operate income-generating real estate. They offer a way to invest in large-scale income-producing real estate assets without directly buying property. How do REITs work? Structure and formation, legal structure. REITs are typically structured as corporations or trusts. They are required by law to comply with specific regulations, including distributing at least 90% of their taxable income to shareholders in the form of dividends. Types of REITs. There are different types, including equity REITs, which own and operate income-generating real estate, mortgage REITs or MREITs, which provide financing for income-producing real estate by purchasing or originating mortgages, and hybrid REITs, which combine both equity and mortgage strategies. Fundraising and investment. Capital-raising REITs raise capital through public or private offerings. Publicly traded REITs sell shares on stock exchanges, while private REITs offer shares to a limited number of investors. Property acquisition. The funds are used to acquire, develop, or renovate real estate properties. These properties might include commercial real estate, like office buildings and shopping malls, or residential properties, such as apartment complexes. Income generation and distribution, rental income. The primary revenue for equity REITs comes from rental income generated by the properties they own. For mortgage REITs, income comes from the interest on the loans or mortgages they hold. Dividends. By law, REITs must distribute at least 90% of their taxable income as dividends to shareholders. This makes them attractive to income-focused investors. Liquidity and market presence. Trading publicly traded REITs are listed on stock exchanges, allowing investors to buy and sell shares just like any other stock. This provides liquidity and the ability to invest in real estate without direct property ownership. Accounting and financial analysis. Financial reporting income statements. REITs report rental income, property operating expenses, and net income from their operations. Key metrics include funds from operations, or FFO, and adjusted funds from operations, or AFFO, which provide insights into cash flow generated by real estate operations. Balance sheets. These show the value of the properties owned, debts, and equity. Real estate assets are often valued using fair value accounting or historical cost, depending on the accounting policies of the REIT. Valuation metrics. Price to AFFO ratio. This is similar to the price to earnings, or PE ratio for stocks, and is used to evaluate a REIT's valuation relative to its cash flow from operations. Cap rate. The capitalization rate is a measure of the return on investment based on the income generated by the property. It's calculated as net operating income, or NOI, divided by the property's purchase price. Tax considerations. Tax benefits. REITs benefit from special tax treatment. They are generally not taxed at the corporate level, as long as they distribute the majority of their income to shareholders. This avoids the double taxation typically associated with corporate earnings. Benefits to society. Economic development. Urban revitalization. REITs often invest in developing or redeveloping urban areas, which can stimulate local economies, improve infrastructure, and enhance property values. Job creation. Employment opportunities. The construction, management, and operation of real estate properties create jobs and stimulate economic activity in the surrounding community. Affordable housing. Social impact. Some REITs focus on affordable housing projects, helping to address housing shortages and providing more options for lower-income families. Community services, healthcare and education, REITs. Investing in properties like hospitals and schools contribute to essential community services, improving access to healthcare and education. Summary: REITs offer a dynamic way to invest in real estate through a well-regulated structure that provides income and liquidity. For accounting and finance students, understanding REITs involves looking at their unique financial metrics, tax implications, and their role in the broader economy. They provide a bridge between individual investors and large-scale real estate investments, contributing positively to economic and social development. If you found this breakdown helpful, make sure to like, subscribe, and hit the notification bell for more insights into accounting and finance topics.